everyone that invests should have an investment philosophy. And if you invest and you don't, that's a recipe for disaster, and you're probably going to lose all your money. Mine is investing in companies based on their fundamentals. Today I'm going to talk about how that I started to invest like that. I'm an RIA, registered investment advisor, based in Southern New Hampshire. If you're interested, then there's more information in the description. So first of all, when I started investing, I had zero idea what I was doing. I had read some books about the topic, but they hadn't really made much sense. And I mean, I read a lot, but those books they use a lot of industry jargon. But one thing that hit was buy low and sell high. That hit. So, of course, when I started investing, the first day I put like $2,000 in an account, and I decided, okay, let's find what has declined the most. So I went. I found in the pre-market the stocks that had declined the most, and there was one that was down by 50% in the pre-market that day, and it was down, including that decline, it was down 80%. So it had traded at like $100 or $200 a share, and was trading. It opened around 23. So I was like, let's buy. And I put 10% of the portfolio I invested in that stock. I bought 10 shares at $23 a share, and it mooned. It went up over 80%, and it closed the day up 60%. And I thought, man, this is easy. This is shooting fish in a barrel. Sadly, I didn't sell, and ultimately I lost about $80 on that position. But I effectively paid $80 for a course on how to invest. And so in the days afterwards, I was holding, and I was reading an article online about this company, and they wrote about how this company there was a fairly big problem with one of their core businesses, and I felt a sinking feeling as I was reading that, and that's when I sold my first shares in the company. But after I had sold, I wasn't going to stop investing, because I knew that people had made a lot of money investing. So I decided I'm going to figure out how to invest correctly. So how did the person know that this investment was a bad investment beforehand? And how could I learn that? So then I learned about 10Ks. This is not a run. A 10K is a document that public companies are required to file with the SEC. Public companies based in the U.S. are required to file with the SEC once a year. There's 10Qs every quarter, and then a 10K once a year. So I started reading 10Ks and then looking at the fundamentals in other software programs that basically pull from those documents so you can get multiple years at once. And as I learned more, I was gradually able to pick out companies that I would use a discount rate, a little above what the market was, and there weren't many companies that reached that discount rate, but there were a few. And as I invested more, I was able to make money investing in those companies. And I've refined my process over the years, but it's essentially read regulatory disclosure documents of companies, see if they meet discount rates that I set, and then if they do, invest in them and watch how they perform and follow up with the earnings calls they do generally every quarter, et cetera, et cetera, et cetera. If you're interested in more content like this, please like and subscribe. Thanks for watching.